So somebody asked me today, Gates, I had a short idea on Apple, but Apple took off and bounced. It didn't break down, so I didn't take the trade because my short idea didn't play out. But yet, you took the trade when we traded live, and your short idea didn't play out, and you went long. So I was a bit confused as to why you went long against your plan when you preach to follow your plan. My answer to this question was we have to adjust. We need to adjust as traders. We cannot marry a plan. We can create a plan. We can have a plan in place and ready to take a trade if the stock moves a certain way, but we must go into the market without bias, with a clear mind, and with the understanding that anything can happen at any given point because there are so many variables that affect the market. So let me break down the trade for you and what happened and what we were looking for and why we adjusted the plan and went long instead of short. So Apple today, short idea below $173.53. This is posted on the day trade watch list before market open within the Discord server. Apple short below 173.5. So we'll just draw a trend line right here at 173.5. So here's our trend line right here. Apple opens up and drops down to 173.5 and then bounces and reclaims the previous day's closing price. Now, we know that Apple has been on the daily chart time frame selling off, right? It had the Apple event and apparently nothing new was mentioned there. Investors weren't excited about what they saw. Apple sold off. It's the old adage, you buy the rumor and then sell the news, right? So news event comes out, sell the news, the stock drops. So Apple's been dropping the past couple of days. While most stocks have kind of been running and pressing and making new highs, Apple's been showing this relative weakness. Well, today, majority of the market does gap up, and Apple, instead of, we'll move to the 5-minute time frame here, Apple, instead of gapping up, is actually opening lower than the previous day's close. So in a way, it's almost gapping down a little bit. I mean, not by much. It's pretty much just a flat open, right? So Apple's essentially giving us a flat open. And then if we look at what SPY does for the first, let's just say 15 minutes here, 5, 10, 15 minutes, SPY's just consolidating and moving sideways, but making these lower lows and eventually like starts to sell, right? While Apple, on the other hand, is not doing that at all. Apple's actually first 15 minutes pushing, 5, 10, 15 minutes pushing up. So right off the bat, Apple is not only validating our short trigger level here as a point of support, which is short below 173.5. Remember that. So it's not only validating our short level as a support, it's also reclaiming the previous day's closing price and showing relative strength, pushing against the market while the market's consolidating and then eventually selling off. So we adjust as traders. We can have a plan to take something short or long, of course, right? Apple was a really great short setup if that's what it was showing us. But we can adjust that plan based on what we see intraday. Apple's price action this morning was not telling us that it was going to sell off or that it is selling off or that it's showing any sort of weakness. So why would we continue to look to take this short against what we're visibly seeing happen right in front of us? And I think that this is a mistake that a lot of traders make where, they create a bias on a certain stock and feel that because they have created this bias, the stock should move the way that they think it's going to move, when in fact, that is the total wrong way to approach trading because nothing needs to move the way that you think it's going to move, and having that bias can create losses, right? If you're looking at this and you're like, oh, it's got to sell, it's been showing relative weakness the past couple of days, I'm shorting, like you're getting caught up in a move that's moving up and then eventually continues to grind up and up and up, right? And that's a bad situation to be in. So have a plan, yes, by all means, create a plan. You can prep to go long or short on certain stocks, but by the time the market opens, you need to have a clear mind. Understand that anything and everything could happen at any time. The market does not need to move the way that you think it's going to move. And our job as day traders is to identify which way the market's moving and then plan our trades around that direction. That is the way we are going to be profitable. So we identify this. Apple's holding support. Apple showing relative strength. Apple's reclaiming the previous day's closing price. What do? We decide to go long. We're not going to go short on this. We're going to go long. But we're not going to go long while this is running. So this whole time, we're watching it, right? Trading live, we're watching it. We're looking for a dip. We're just not offered a dip. So it's not until here that we get our first dip entry offered. And we go ahead and take the position long. Now, what I said to the team is that my plan is to add into this as it's coming down close to the previous day's closing price with a stop at the previous day's closing price. So we enter the trade long here, and we're pretty much immediately red. The video that I made yesterday called Trading the Chart, Not the P&L, is another prime example of doing just that. We're not focused here on the P&L. We are trading the chart. We're trading our plan. Our plan is to go long on this with a stop at the PDC and to add as we get closer to the PDC. Now, we're not just going to add into this trade, right here and right here, because it's showing us that it could be moving up. It doesn't make sense to add there. That does nothing to lower our cost basis. When we average into a trade, we need to be precise with it. We need to add at specific points that make sense for us. Something that does something to lower our cost basis, right? Because that's where the advantage lies. So we're red on the trade immediately. Then we're back to break even, and we're even slightly green on this trade. And then it pulls back further. Now we're down, I think, like 15 or 20% on the trade. Now it makes sense to add here. Because what does that do? It does something for our cost basis. So we're able to average down on our contracts. I think we had an average of 125 when we first entered. We averaged at 1.0. We wound up with an average price of 1.12. And then as soon as we average into the trade, boom, we get a pop move up, next candle, and we're green right away. And then we get a break of this downward trend line here, and the stock continues up, and we're green until we hit finally 20% profit, which is where we took our profits at. And coincidentally, this is also the high of day area, the resistance area, if you will. So regardless of being up 20% here or not, when we see that this is starting to show resistance at the high of day, we should be taking the profit. So if we were only up, let's say we were only up 13% at the peak here, and we start to see this weakness come in, we might go ahead and just take the profits because we know what high of day is always going to be a likely point of resistance. So again, another fine example today of trading the chart and not the P&L, but also showing you that we can have a plan in place, but by adjusting and trading without a bias, we're able to ditch that plan, create a new plan as we see price action, and position ourselves correctly in a trade. Thank you for watching. Hope this has helped you out. Press the like button for me if you haven't done so already, and subscribe to the channel. I'd love to see you around. I create some awesome videos from time to time. All right, take care, and I will see you in chat.